All right, hello everyone. That's me down in the bottom right corner there, but I can't see me because we got a Joseph Kennedy quote in front. I mean, sorry, Jesse Livermore. But anyway, that's probably better to look at than what I look at. Anyway, I just want to talk about SPY or the S&P 500 ETF or the market in general. And we look at the S&P 500 because it's the most important benchmark there is. Now, when I say benchmark, what do I mean by that? Well, it's an index. It's 500 stocks. In the institutional trading world, whether you're a hedge fund trader or manager or mutual fund manager, you need something to judge your performance against. I mean, no one's going to give you money and just be like, okay, do whatever you want with it. They are going to have a benchmark, right? Something to compare you to. And if you have a better return than the benchmark, you're doing a good job. And you have a worse return than the benchmark, you are not doing a good job. So we usually start off with the S&P 500. Now, I like to look at the SPY ETF. This is the S&P 500. Well, let me start again. This is Standard & Poor's Depository Receipts, S&P 500. So this is an exchange traded fund, which means people can trade it. You really can't trade the index itself unless you're some big institutional player. And even then, you can't trade it directly. You could trade like futures and so forth. And for our intents and purposes, looking at this ETF is fine. And believe me, plenty of institutions look at this thing too. I mean, it traded 92 million shares on Friday. So we are fortunate that Standard & Poor's follows this, or actually, I don't know about follow it, but they develop this. And it's an ETF, an exchange traded fund. And we can go look at the fact sheet. Every ETF has a fact sheet, and we could see the composition. Now, if you want to trade SPY, it's important to understand that different things drive the market at different times. Different things are in the driver's seat. Sometimes tech is leading the market. Sometimes healthcare is leading the market. Sometimes it's consumer discretionary. Sometimes the most important thing to think about is energy. It changes. Sometimes it's complicated. Sometimes it's kind of simple. I think now is one of those kind of simple times. And I think we're going to get what is going to be a clear signal in our financial sector. And we'll take a look at that. Now, if you are an options trader, you can buy puts on SPY and so forth and so on. If you're not, there's ETFs that will go down if S&P goes up. For example, notice how on Friday S&P was down 76 basis points. Well, let me look at this ETF here. Let me show you this ETF, which is an ETF that is designed to trade inversely. Okay, SH, the Pro Share Short S&P 500. Notice how it's up pretty much by exactly how much the S&P 500 is down, right? A couple of basis points different here, but for all our intents and purposes, it's like whatever, it's the same thing. So my point is, if you think the market is going to go down, and frankly, I do, of course, I'm not right all the time. I mean, I'm right a good amount of the time, but whatever. It's not about me now. It's about you. If you think the market is going to go down, you don't need to just hold your head in the sand like you're an ostrich, right? You don't need to just go to cash. You can put your money to work in a way that it will appreciate, or your portfolio will gain in value if the market is going down. One of the things you can do is buy SH. It will go inversely. If the S&P 500 is down 5%, this will be up 5%. Now, of course, you got to remember, like anything in investing, there's no perfect story. So if you're wrong and the S&P goes up, you're going to lose money here. But I'm going to show you why I think that the market is probably set up for a move lower. And market is always right, and I'm not, So we got to let the market tell us what to do. And I'm going to tell you where I'm looking this week. Okay. So we got the 431 level here for SPY. If the financials break down, my suspicion is this breaks down and it makes a pretty decent and rapid move lower. Let's take a look at let's take a look at the sector. So here's the S&P 500. Here are the sectors. Okay. Tech is the biggest, healthcare is the biggest, financials are the third. Different sectors are in the driver's seat at different times. You don't really see utilities, materials, or real estate being in the driver's seat. They're very small weightings. But Yeah, so I mean, there's always trading ideas in all these sectors, but in terms of what's going to really move the market, we don't really need to pay attention to these. But if we're looking for trading ideas, we will. Energy is only 4%, but energy is bigger than it sounds because it affects all companies. Consumer staples is pretty small as well, but we like to pay attention to consumer staples because these are stocks that are considered safe. In other words, a staple is something you need, like food or medicine, as opposed to something that you just want, like diamond rings and luxurious vacations. So sometimes when money is flowing into consumer staples, it tells us that there's what we call a flight to safety going on. And a lot of times consumer staples get really strong right before the market's about to go lower. But today I want to look at the financials. And specifically, I want to look at the banking industry. Now, these are the sectors, okay? This is the financial sector. This is the ETF that tracks the financial sector. Within sectors, there are industries. Now, you can see that this chart looks pretty weak, all right? But there's a couple things I want to point out here. In the markets, some price levels are more important than others. You can see that here. Pretty simple. You don't need to be a former hedge fund trader. And I'm really sick of hearing about former hedge fund traders. And I am a former hedge fund trader. So I just think it's kind of like whatever. There are former hedge fund traders who suck and don't know their ass from their elbow. But anyway, check this out. Support, and this is the like 3250 level, turned into resistance. Resistance turned into support. How does that happen? Support turns into resistance. Well, it's because of investment psychology. There are people who bought here who thought they made a great decision when the market went higher, but then the price goes lower, and they tell themselves, man, I made a mistake. I want to get out of this. If I can, I'm going to, but I'm only going to do it if I can get out of break even. So I don't have to lose any money. So they place their sell orders at the same level they had their buy orders. If there are enough of these remorseful buyers placing sell orders, the support level converts into resistance. Okay. Some price levels are more important than others. That's just how it is in the market. Here we see resistance turn back into support. How does this happen? Once again, it's investment psychology. This is seller's remorse. People sell. They thought they were great when the price went lower, but then it goes higher. And a lot of these people tell themselves, I made a mistake. I'm going to buy my shares back, but I'm only going to do so if I can get them for the same price I sold them at. So if there's enough remorseful sellers placing buy orders at the level that was resistance, it converts into support. Here's another example of psychology. Why would a level that was clear resistance become clear resistance months later? Well, there's buyer's remorse here too. It's just to manifest it in a different way. There are people that bought up here that tell themselves once the price goes lower, oh man, I made a mistake. If I can get out at break even, I'm going to. So you have remorseful. Well, look, and you can even go back to there, right? Support becomes resistance. So you have remorseful buyers telling themselves they're going to sell if they get out at break even. So if you have enough of these buyers placing sell orders, the level that was resistance, it stays resistance. Psychology. You have to look at these charts through the prism of psychology. Now, let's look here. So this is the financials. Again, I think this is the most important thing to watch this week here. Why would something get to resistance? And there was resistance there because it was support here. Remember, buyer's remorse. There's people who bought here who regret doing so when the price goes lower and they want to sell at break even. So they place their sell orders at the level they bought at. This is not about the debt ceiling. This is not about Taiwan. This is not about the deficit. When you look at a chart, you have to look at it through the prism of supply and demand or investment psychology. If you don't, you are going to have a very difficult time reading charts. If you do, all of a sudden, all this stuff is going to make sense. So support becomes resistance because of buyer's remorse. Resistance remains resistance because of buyer's remorse. Why would we get to resistance and just sell right off? Well, there's investors who want to sell and they're watching the price move higher. And all of a sudden they notice the price isn't moving higher anymore. So they deduce correctly that, oh, gee, there must be other sellers coming into the market. That's why we're not going higher. When we're moving higher, there's not enough supply or sellers to fill all the demand or buy orders. When we get to resistance level, all of a sudden there is. Now, some of these investors are like, wow, it's not going any higher. Other sellers must be coming to the market. Oh, gee, will I be able to sell my shares? Well, if there's someone who's willing to sell them at a lower price, You're not going to be able to. The buyers are going to go to whoever wants to sell at the lower price, or who's willing to sell at the lower price, I should say. So you get these sellers undercutting each other, and it creates this snowball effect. And this is what drives us lower when we get to resistance. We got there, we got here. It's not about fundamentals. It's not about this. It's not about that. It's about psychology. It's anxious sellers that are afraid they're going to miss out. So they reduce their prices. Support's the opposite. Why do we bounce off of support? Well, there are people that are buying that are afraid they're not going to be able to buy if someone else is willing to pay a higher price. So they start bidding higher prices, and then you get this snowball effect on the upside. If you understand where these resistance levels are and these support levels are, you're going to have a lot easier time making money. So that's what a lot about. It's a lot of what I talk about here at Stock Market Jobber. So anyway, we got to resistance, didn't get through. We're going lower. Here's what I want everyone to watch this week. The banking industry ETF. So the financials are the sectors. This is an industry within the sector. Now, look at this. This is the banks. Remember, we just had Silicon Valley. We had First Republic, right? And the politicians are telling us, oh, gee, we're backstopped. We're bailed out. Everything is hunky-dory, blah, blah, blah. Well, you know what? I don't listen to politicians. I don't listen to stock experts. I listen to the market. And what is the market telling us? Does this look to you like something that is a sector, or sorry, an industry that's been saved? No, this looks terrible. We just broke this important level that goes all the way back to 2020. We got to resistance. Like I said, we sold off, got to resistance again. Resistance had become support because of seller's remorse, but we broke right through that on Friday. I think you watch this. If there's one thing to watch, you watch this. If this recovers, the market's probably going to be flat. But if it doesn't and it continues to trend lower, market's going lower, and then we could talk about what puts to buy, what inverse ETFs to buy, and so forth and so on. Okay, everybody, thanks for tuning in. I will be back tomorrow day in the morning, and I will see you then.